What's up YouTube? I'm Ryan from Tattooed Trades. In this video, I'm going to go over why the 2022 recession is different, how we got here, what to expect. I'm also going to give you some fundamental and technical analysis on the S&P 500 and some indicators you can use that'll help you in your trading and investing in the weeks to come. So stick around because this is going to be a good video.
Wake up, today's going to be a good day. Wake up, today's going to be a good day. Wake up, today's going to be a good day. Wake up.
All right, two things we got to get out of the way before we start the video. Number one, I'm not Jim Cramer's son, I'm not his uncle, and I'm definitely not his nephew. So I'm not a financial advisor. Please take anything you hear as just entertainment. Do not use it to make investment decisions. I'm not telling you what to buy, and I'm not telling you when to buy. Number two, this is a new YouTube channel, so please watch this video in entirety, and if you find value in it, consider liking, consider subscribing, and please share it on your social media for anybody else that might be fearful of the recession. So why is the 2022 recession different? In order for me to answer that question, I kind of have to break down Barney style how we got here. If you haven't been living under a rock for the past 2 years, you know that COVID hit. And when COVID hit, the global markets shut down, right? The global economy shut down. You had manufacturing oil at a standstill, and you had people home, sitting home from work. Now, what had happened when that happened was we went into a deflationary period. And a normal everyday person thinks that deflation is good, right? You know, if things cost less, you'll be able to buy more of them. There's more money in your savings account, and all is good, right? Wrong. Any capitalism, democratic society wants an inflation rate of 2% a year. Now, they want 2% a year because that keeps up with the average wage increase. And this is why doing things like increasing the minimum wage too fast can be bad for society, right? Because it increases people's money supply when costs are the same. And that's bad. And I'm going to go into that. I'm going to go into why it's bad right now. When things are cheap and people have a lot of money, you get what's called demand pull inflation. That's when the demand for things is really high and the cost is really low, which elevates price levels. That causes inflation. And then when things like that happen, you get cost push inflation, where the demand is the same, but the supply is low, which increases prices. And we all know that increased prices lead to inflation. So with everybody sitting at the house, Big Daddy Fed starts pumping a ton of stimulus money into the economy. So you got a load of demand from people that are at the house and not a lot of supply, which in turn puts the economy into an inflation spiral. So the deflation that happened was bad because with oil prices low and everybody at the house, people were, out and about, which they shouldn't have been, but a lot of people were, which depleted the supply of oil that they weren't making and in turn started raising the costs. Logistics, transportation started getting more expensive. And when the economy opened back up, you had limited supply and a ton of demand and a ton of people around with a ton of money that wanted to take advantage of it. We see this happening every day. We see it happening with the airports. We see it happening with airlines, with gas prices. So last week, inflation data comes out, right? So when looking at these numbers, you notice that CPI year over year was 9.1% in June. What that means year over year means that these numbers are compared to June of last year, when the economy was booming. We also want to look at core CPI. So core CPI is when they actually take oil and food costs out of it. And what we're looking at in this economy is oil and food being those main factors that are pushing inflation. So the federal government has two tools in its toolbox that they can use to fight inflation. Now, one is fiscal policy and the other is monetary policy. Now, both of these policies can do one of two things. They can be expansionary or they can be contractionary. Now, in fiscal policy, you got things like increasing taxes and increasing government spending. So the government spending money on infrastructure, creating new roads and creating jobs those way. Those are expansionary policies that will help heat up a slowed economy. And that's what happened, right? When everybody was sitting at the house, the government started to realize that we were in a deflationary period, that the economy was getting stale. So they started using fiscal policy to heat it up. And in turn, creating that inflation spiral that caused inflation to run out of control. And now what they're doing is they're using monetary policy, which includes lowering and raising interest rates, again, expansionary and contractionary. So what they're doing by raising interest rates is they're trying to contract the overbooming economy that we've been in for the last year. And in turn, these high inflation numbers have caused the S&P to go into a bear market. And why this recession is different is because with increased interest rates from the Fed expects that to start affecting the labor sector. They want layoffs. Unfortunately, in capitalism, for it to work, some people have to suffer. So the goal is a 5% unemployment rate. But what happened is because people were sitting at the house, they learned to make money in other places. They learned to start their own business. They had a ton of money to invest, right? Started day trading. And what that causes is a decrease in the labor market of people that were willing to work. So the reason why this recession is different is because the Fed right now wants layoffs, but the labor market is still in demand. So you have this kind of oxymoron. And the only thing we're going to be able to do is wait to see how it works out, And there's a few key indicators that we can look at to help us make better trading decisions, better investing decisions as we move forward through this recession. Now, one thing we can look at is the VIX, which shows the overall fear and panic in the market. Now, what we're going to do is we're going to pair that with the skew. Now, if you look at the skew is a indicator that ranges from 100 to 150. Now, what that means is when it's closer to 100, it means that people are buying out of the money put contracts to hedge their long positions. When it's closer to 150, it means they're buying at the money put contracts to hedge their long positions. So you'll notice that if it's closer to 150, it means people are expecting immediate downside risk, all right? And if it's closer to 100, people are hedged well against impending downside risk. And what a lot of people are looking for in this market is capitulation. They're looking for the VIX to rise like it was in COVID over 40. They're looking for that massive sell-off that could signal the bottom. But these are two indicators that you could put together to kind of come to a realization that maybe that's not going to happen. Because with the skew sitting at 122, it shows that people are well hedged in this market, right? And there's not a lot of fear. So the VIX under 30 is a good sign that this market is accepting this recession well. So what this leads me to believe is that we could be just looking at a change in valuation. And I want to pull up this really good email from Artie Aziznia, who is a part of Peak Capital Trading. He's with Bear and Bull Traders, a real good financial analysis. And I want to show you what he wrote in this email because I really think it pertains to what we're seeing in the market today. So as you know, we're coming in earnings season, right? And who goes first in earnings season? The banks. Now, Artie has put this together. For starters, all eyes are on Q2 earnings right now, right? Banks kicking them off. So the things that affect bank earnings are loan generation and loan loss reserve ratio. Loan generation is the pulse of an economy. The more loans banks generate, the more money they make, the more stronger the economy is. Now, if you pair this with the increase in interest rates, people are going to be buying money a lot less because money is more expensive. All right. Let's go down to the bottom in the email because this is what I think is most important. Okay. Now, if we're looking at a devaluation of the S&P 500, on average during recessions, earnings drop 15%. If we assume that the SPX earnings will have dropped 15% from last year, that puts earnings of the SPX at 162. Now, the SPX is the S&P 500, okay? With the 10-year Treasury yield at 3% based on Artie's regression model, the implied fair value of the SPY would be around 373, all right? He believes there's still downside risk because we are trading about 200 points above that, I believe. And there will be more downside risk if these bank earnings and the earnings coming up start to disappoint. So that leads me into the technical analysis of the S&P 500, all right? Here we have the SPY on a daily chart. Now, this right here was the gap down from CPI. And as you could see, the market took it well, right? Pre-market dropped 2%. You can see it gapped down, started to sell off, and then got bought right back up. So what I want to do is I want to switch over to the weekly chart. We can see on the daily chart that the SPY reclaimed the 9. OPEX on Friday brought a lot of volume into the market, and the volume was constructive. If you look at VOLD, the last 2 days was very constructive volume. So let's go here to the weekly chart. And what I want to do is I want to draw a channel to kind of give an idea of what I'm looking for here. Push down here. All right. So I always zoom out onto a higher time frame to get my SPY analysis. I always go to the weekly chart. What we're looking at is this downtrend that the SPY's been in for the past couple of weeks. And we noticed that last week the SPY closed in a really bullish hammer, right? A lot of volume. And what we want to see is we want to see the SPY hit this upper end of the channel, and that's when we want to feed Randy Savage Slim Jim, right? That's when we want to see the Macho Man break through the wall. We want to see the SPY run through not only this prior pivot, but this downside channel like Frank Gore. All right. And if we see that, we know that we're going to get some upside continuation. So what I'm looking for this week is a break of this downside channel, and I'm going to trade the momentum accordingly. The only thing that worries me here is the fact that we have a lot of gapping and we have a lot of intense moves. If you notice, every time we get these wide range bar with intense gaps and intense moves, we get parabolic reversals, and it's happening in both directions of the coin. What we want is we want to go back to these slow grind ups, right? We don't want these crazy gaps and wide range bars, because this is what happens when that type of stuff happens, right? We want these slow grinds. So what I want to see, especially if I'm going to start swing trading, is I want to start to see slow grinds up that break some of these prior pivots. So guys, please take some of these things into consideration when you're making your investing and trading decisions. Have a look at the VIX, have a look at the skew, have a look at the treasury bonds. Start to piece together your own economic data to make informed decisions about your investing. I think the only really downside risk we're looking at is when they bring out GDP at the end of the month. That's when you can officially say we are in a recession if the GDP is negative. And I don't want everybody to be afraid about that, because if you look at the economy, yes, things are high priced right now. And hopefully we start to get into a deflationary period to kind of bring it back down. But businesses, jobs are still hiring. And what people are afraid of the most during a recession is losing their job, right? And that doesn't seem to be happening yet, even with a hawkish Fed that's raising interest rates. Now, if we jump back into the calendar, we have a lot of earnings to look out for this week. On Monday, we got Charles Schwab, IBM. Tuesday, we're getting into Netflix, IB, that's where I trade with, JB Hunt, who I actually used to work for when I was a truck driver. We got Tesla, everybody's favorite, on Wednesday. Tesla's going to, light some fires. Then we're going to get into Snapchat, or Thursday's kind of dull. Friday, American Express. Some of these are going to be great gap trades. During earnings season, you can usually back the truck up, trade the gaps. Listen, I hope you guys found value in this video. If you did find value in this video, please consider subscribing, please consider liking, and please share this on your social media so other people who aren't economists can get some information on what's going on in the economy and what's going on with their 401ks. Guys, stick around. Thank you for watching, and I will see you on the next one.